A bank was a bathtub with one faucet and 300 drains. The moment everyone yanked their drain at once, the tub went dry in hours. December 1930. The Bank of the United States collapsed in New York, wiping out 400,000 depositors. By 1933, over 9,000 banks had failed, erasing $1.3 billion in savings. So how do you stop a crowd from draining a tub that only holds so much water? That question exposes the lie at the center of the whole system. Fractional reserve banking meant only a sliver of every deposit sat in the vault as cash. The rest was already out the door, tied up in mortgages, farm loans, and business credit that couldn't be called back on demand. So a rumor, true or false, was enough to start a run. Withdrawing became the danger itself, a self-fulfilling prophecy with real families' money on the line. New York proved that no bank was too big to drown. The Bank of the United States failed on December 11, 1930, holding $200 million in deposits, the largest single bank failure the country had ever seen. 400,000 depositors, many of them immigrants and working-class New Yorkers who trusted the name on the building, woke up to find their savings frozen behind locked doors. The bank had 62 branches across the 5 boroughs, built over 16 years by founder Joseph Marcus, who started it in 1913 as a small Lower East Side institution serving Jewish immigrant families who'd been turned away elsewhere. Marcus's son Bernard ran it by 1930, and regulators later found the bank had merged with 3 shakier institutions that spring, absorbing bad real estate loans it never disclosed to depositors. New York State Superintendent of Banks Joseph Broderick was indicted, then acquitted, on charges he'd known the bank was insolvent weeks before he let it keep taking deposits. Size had bought them nothing. One failed drain pulled the water from every tub nearby. Nearly 1,300 banks went under in 1930 alone, and healthy banks got drained too, because depositors reasoned that if that bank could fail, theirs could. In Nashville, the collapse of Caldwell and Company in November 1930, a holding company controlling banks and insurance firms across 8 southern states, dragged down 120 affiliated banks within a year. Fear traveled faster than any examiner could calm it, and by early 1933 the damage had compounded into more than 9,000 failed banks since 1930, with roughly $1.3 billion in deposits gone. In Detroit alone, Governor William Comstock closed every bank in Michigan on February 14, 1933, after the Union Guardian Trust Company, tied to auto executives Henry and Edsel Ford, teetered toward collapse and threatened to take the whole state's banking system with it. The math of panic is brutal. It doesn't need a real reason, just a plausible one. Eventually, the whole system had to be shut off at the main valve, Franklin D. Roosevelt declared a nationwide bank holiday on March 6, 1933, closing every bank in the country for 4 days just to stop the bleeding, invoking authority under the 1917 Trading with the Enemy Act because no dedicated peacetime statute existed yet. Treasury Secretary William Woodin oversaw an army of bank examiners, nearly 5,000 of them, who fanned out to more than 17,000 banks nationwide to sort the solvent from the doomed. 3 days later, on March 9, 1933, the Emergency Banking Act passed both houses of Congress in under 8 hours and let regulators walk through the vaults and inspect banks before letting any reopen. By March 15th, roughly 70% of banks in the Federal Reserve System, about 12,000 institutions, had reopened their doors. It was the financial equivalent of turning off every faucet in the country to check which pipes were actually broken. With the water shut off, Washington had to ask why nobody had fixed the drains sooner. Deposit insurance wasn't new. It had been proposed and rejected by Congress more than 150 times going back to the 1880s, and 8 individual states, including Oklahoma in 1908 and New York in 1829 with its safety fund, had tried versions of it themselves, all of which eventually collapsed under the weight of their own claims. The American Bankers Association fought it hard, warning that guaranteeing deposits would let reckless banks gamble on the dime of the careful ones. Roosevelt himself was initially skeptical, reportedly telling advisors in early 1933 that federal deposit insurance would reward bad bankers at the expense of good ones. Senator Carter Glass of Virginia, a former Treasury Secretary who'd helped design the Federal Reserve System back in 1913, and Congressman Henry Stegall of Alabama, chairman of the House Banking Committee, pushed the plan through anyway, betting that a system this fragile couldn't survive on caution alone. That bet became law, and the tub got a backup line. The Banking Act of 1933, known as Glass-Steagall, was signed by Roosevelt on June 16, 1933, creating the Federal Deposit Insurance Corporation, which opened for business on January 1, 1934, under its first chairman, Walter J. Cummings, a former banking executive from Chicago. The same act also separated commercial banking from investment banking, forcing giants like J.P. Morgan and Company to spin off securities arms, a rule that stood for 66 years until its repeal in 1999. Every depositor's account was now insured up to $2,500, a figure raised to $5,000 before that same year was out, covering an estimated 98% of all deposit accounts in the country at the time. For the first time, your money didn't depend on your bank's luck. The proof came almost instantly. In 1934, the first full year under FDIC insurance, only 9 banks failed in the entire country, a number that had been in the thousands just years before. By comparison, 4,000 banks had failed in 1933 alone before the FDIC's coverage took effect. Depositors stopped running, not because the banks had gotten safer overnight, but because the money itself was now guaranteed by the government, not by whatever the bank had on hand. The FDIC's initial fund started with just $289 million pooled from assessments on member banks, a fraction of what it insured, yet it never had to test that gap in its first decade. The drains were still there. They just didn't matter the same way anymore. That shift rewired how an entire nation related to its savings. Bank runs as a mass phenomenon essentially vanished for the next 4 decades, with annual bank failures in the United States rarely climbing above single or low double digits between 1934 and the mid-1970s. A small saver in rural Ohio now had the exact same protection as a wealthy account holder in Manhattan, something the system had never offered before. By 1966, FDIC coverage had risen to $15,000 per depositor, and by 1980, it reached $100,000, tracking inflation and the growing size of the average American savings account. The FDIC sign on the door stopped being paperwork and became a psychological fact. People believed in it the way they'd once believed, wrongly, in the vault itself. But guaranteeing the water supply raises an uncomfortable question about who's still watching the pipes. Economists called this moral hazard, the idea that banks might take bigger risks once depositors stopped scrutinizing their every move. Critics argued the insurance had shifted the job of risk monitoring away from depositors, who had skin in the game, onto government regulators, who often didn't move fast enough. That argument came roaring back during the savings and loan crisis of the 1980s, when more than 1,000 savings and loan institutions failed between 1986 and 1995, costing taxpayers roughly $124 billion after the separate Federal Savings and Loan Insurance Corporation itself went insolvent and had to be folded into the FDIC in 1989. It resurfaced again in 2008 when Washington Mutual's collapse on September 25th of that year, with $307 billion in assets, became the largest bank failure in American history, dwarfing even the Bank of United States 78 years earlier, followed weeks later by the FDIC brokering the sale of Wachovia to Wells Fargo to avoid another chain reaction. 90 years later, the tub still has the same design, just a bigger backup tank. FDIC coverage today insures deposits up to $250,000 per depositor, per bank, a level set in 2008, and made permanent by the Dodd-Frank Act in 2010, and the fund has paid out for over 9 decades without ever needing a taxpayer bailout of its own, financed instead through premiums charged to the roughly 4,500 banks and savings institutions it currently insures. Even the 2023 failures of Silicon Valley Bank, holding $209 billion in assets, and Signature Bank, with $110 billion, were absorbed by the fund and emergency measures without a direct taxpayer check being written. The tension Glass and Steagall wrestled with in 1933. How much safety a system can offer before that safety changes behavior never got resolved. It just kept resurfacing every time the water rose again. Crust be each he, see currency, that saved, he banks. Deposit insurance didn't stop banks from failing, which turned out to be the more important problem. That single shift, ensuring belief itself, kept the American banking system standing for the rest of the century. So where do you land? Was guaranteeing every saver's money the fix the system needed, or did it just trade one kind of risk for another one we're still paying for? Drop your take in the comments, and if this kind of history clicks for you, stick around and subscribe.